Hey everyone, welcome back to Stock Sahara. In the vast landscape of financial opportunities, one question often emerges above the rest. Why should we invest in stocks? Let's unfold the answer in the next few minutes. Imagine this. The money in your bank account is like a tiny seed. Now, left alone, it might just stay a seed, small and unassuming, right? But what if you could plant this seed in fertile ground where it could sprout, grow, and transform into a towering, robust money tree? That's what investing in the stock market can do for your savings. Now you might think, but isn't investing risky? Sure, there's always some risk, but think of it as gardening. With the right tools, knowledge, and timing, you can cultivate a garden that thrives. The same goes for the stock market. With smart choices and a bit of patience, your financial seeds can grow into a lush canopy of wealth. So, how do you start? First, educate yourself. Learn the basics of stocks, bonds, and other investment vehicles. Understand the climate of the market, what makes it flourish, and what could stunt its growth. Knowledge is like sunlight and water for your investment garden. Then, diversify. Don't just plant one type of seed. Spread your investments across different sectors and asset types. This way, if one part of your garden faces a storm, the rest can continue to thrive. And remember, consistency is key. Regularly investing a portion of your income is like regularly watering your plants. It might seem like a small action now, but over time, it accumulates and fosters substantial growth. So, are you ready to transform your savings into a money tree? It's time to grab those seeds and start planting. Your future self will thank you for the lush green canopy of wealth you've cultivated.
Investing is like planting a seed for your financial future. You put money into something with the hope that it will grow over time. You can invest in many things: stocks, bonds, real estate, and more. Investing is important because it helps us reach our financial goals, like buying a house, retiring comfortably, or funding our children's education. Without investing, our money might lose value due to inflation. Inflation is like a hidden tax that makes things more expensive over time. If your money isn't growing at a rate that keeps up with inflation, you're actually losing purchasing power. Investing helps us combat inflation and build wealth. Think of it this way. If you bury a 10 lakh rupees in your backyard today, it'll still be a 10 lakh rupees 10 years from now. But due to inflation, you won't be able to buy as much with that 10 lakh rupees as you can today. Investing aims to grow your 10 lakh rupees into, say, 20 lakhs over 10 years, outpacing inflation and increasing your purchasing power. Investing, however, is not without its risks. It's crucial to understand the different investment options and choose those that align with your financial goals, risk tolerance, and time horizon. Stocks represent ownership in a publicly traded company. When you buy a stock, you become a part owner of that company. Companies issue stocks to raise capital for growth and expansion. As a stockholder, you're entitled to a share of the company's profits, often paid out as dividends. Stock prices fluctuate based on a company's performance and overall market sentiment. This means that the value of your stock can go up or down. If the company does well, its stock price tends to rise and your investment grows. Conversely, if the company struggles, its stock price might fall, leading to potential losses. Investing in stocks offers the potential for higher returns compared to other investment options like savings accounts. However, this higher potential for returns comes with a greater risk. Stock markets can be volatile, meaning prices can change quickly and unpredictably. It's essential to understand that investing in stocks is a long-term game. Savings accounts are like safe havens for your money. They're offered by banks and credit unions. When you deposit money into a savings account, the bank pays you interest, a small percentage of your balance, for letting them use your money. Savings accounts are considered low risk because your deposits are typically insured up to a certain amount by government agencies, such as the RBI in India. The interest earned on savings accounts is usually lower compared to the potential returns from stocks. This is because savings accounts are considered very safe. Banks use the money deposited in savings accounts to make loans and generate profits. The interest they pay you is a small portion of the profits they earn from lending your money. While savings accounts protect your principal and offer a guaranteed return, the returns are generally modest and might not keep pace with inflation. This means that while your money is safe, its purchasing power might erode over time. Savings accounts are best for short-term goals or as an emergency fund, not for long-term wealth building. Compounding is like a snowball effect for your investments. It's the process of earning interest on your initial investment as well as on the accumulated interest. The longer your money is invested, the more powerful the effect of compounding becomes. Stocks, with their potential for higher returns, benefit significantly from compounding over time. Let's illustrate with an example. Imagine investing $1,000 in both a stock portfolio and a savings account. Assume the stock portfolio grows at an average annual rate of 7%, while the savings account yields a 2% annual interest rate. After 30 years, the stock portfolio could grow to approximately $7,612, while the savings account might only reach $1,811. This example showcases the dramatic difference compounding can make over time, especially for investments with higher growth potential like stocks. However, it's crucial to remember that stock market returns are not guaranteed, and past performance is not necessarily indicative of future results. Investing in stocks involves risk, and the actual returns may vary. In the battle for your bucks, both stocks and savings accounts play important roles. Savings accounts provide a safe haven for short-term goals and emergencies, while stocks offer the potential for higher returns over the long run. Choosing the right investment strategy depends on your individual circumstances, risk tolerance, and financial goals. Before making any investment decisions, it's crucial to educate yourself about the different investment options and seek guidance from qualified financial advisors. Financial advisors can help you assess your risk tolerance, understand the complexities of the market, and develop a personalized investment plan that aligns with your financial aspirations. Investing is a journey, not a sprint. It's about making informed decisions, staying disciplined, and focusing on long-term growth. As you embark on your investment journey, remember that knowledge and prudent decision-making are your most valuable assets.
Investing comes in. Think of it as going beyond your piggy bank. Instead of just saving, you're buying a small piece of a company, a stock. Stocks represent ownership in a company. When the company performs well, its stock value increases. This means your initial investment grows. It's like planting a seed that has the potential to grow into a mighty tree. But unlike a tree, stocks can grow much faster. The stock market, where these stocks are traded, can be volatile, but over the long term, it has consistently trended upwards. Traditional savings accounts offer a safe haven for your money, but they offer minimal returns. In fact, the interest earned often fails to keep pace with inflation, meaning your money is actually losing value over time. Investing in stocks while carrying more risk has historically yielded much higher returns, allowing your money to grow significantly faster. Imagine two scenarios. In the first, you put $1,000 in a savings account with a 1% annual interest rate. After a year, you earn $10. Not bad, but not great either. In the second scenario, you invest that same $1,000 in a company's stock. Let's say the company performs well, and its stock price increases by 10% over the year. Your initial investment is now worth $1,100. You've earned $100, 10 times more than the savings account? This simplified example illustrates the potential of stock investment compared to traditional savings. Of course, stock prices can also go down, and you could lose money. But remember, we're talking about long-term investing. Over time, the stock market has consistently gone up. This upward trend is driven by economic growth and innovation. As companies grow and become more profitable, their stock value tends to increase. Section 3. The power of passive income dividends explained. Investing in stocks isn't just about potential growth in the stock's price. It can also generate passive income through dividends. Dividends are a portion of a company's profits that are distributed to shareholders. Imagine owning a piece of a lemonade stand. As the stand makes money, you receive a share of the profits. That's essentially what dividends are. Companies that are profitable often choose to share a portion of their profits with their stockholders. This is a way for investors to earn money without actively working for it. It's passive income, money that comes in regularly without requiring constant effort. Dividends can provide a steady stream of income, especially when reinvested back into buying more stock. This allows you to accumulate more shares over time, compounding your potential returns. It's like a snowball effect. As your investment grows, so does your potential for passive income. Section 4. Active income through stocks, riding the growth wave. While dividends represent passive income, stock investments can also generate active income through capital gains. Capital gains refer to the profit you make when you sell a stock for a higher price than you bought it for. It's like buying a house and selling it later for a profit. The difference is that stock prices can fluctuate much faster than real estate prices. By carefully researching companies, understanding market trends, and making informed investment decisions, you can potentially buy stocks at a lower price and sell them later for a profit. This requires active participation in the market, monitoring stock performance, and making calculated decisions about when to buy and sell. It's not about getting lucky, it's about educating yourself and making strategic choices based on knowledge and analysis. Section 5. Case in point. Let's look at a real-life example. Imagine you invested in Apple Inc. back in 2004. At that time, the company was known for its iPods, and the iPhone was still a few years away. But you saw the potential in the company's innovative products and strong brand. Over the years, Apple consistently released groundbreaking products, from the iPhone to the iPad, and its stock price soared. Someone who invested $1,000 in Apple stock in 2004 would have seen their investment grow to over $20,000 by 2023. That's a 2,000% return. This demonstrates the potential of investing in companies with strong fundamentals and a track record of innovation. While past performance is not indicative of future results, it highlights the potential for significant gains through stock investment. Investing in companies that are revolutionizing their industries and creating products that people love can lead to substantial wealth creation over time. Section 6. Conclusion. Time is money. The key takeaway is this: investing in stocks, while carrying risks, offers the potential for much higher returns compared to traditional savings. Whether through passive income from dividends or active income from capital gains, stocks provide a way to make your money work harder for you. The earlier you start investing, the more time your money has to grow. Compounding, the snowball effect of earning returns on your returns, can turn small investments into significant wealth over time. Remember, time is money, and in the world of investing, the sooner you start, the more time your money has to grow and compound.